Dipen Sheth joins us, Head of Institutional Research with HDFC Securities. Dipen, I want to talk about Indiabulls Group companies. Nobody really talks about it. It's a business it's a group where there is a bit of a black hole attachment because of the lineage and because of the association with political parties. But if I purely look at the wealth what they've created, one single entity, they've demerged various businesses in last 10 or 15 years. The combined market cap of all the companies put together is now 60,000-70,000 crores.
Sure. So we don't have any of their entities under coverage, and hence I don't have what can be called a publishable or expressible view. We know very little about the group, and I would desist from making any sort of claim on them. Okay. There are some things you want to do in the market. There are some things you don't want to do. We don't want to cover them.
Okay, that's a very strong statement there. But what about real estate? Is that also not under coverage? Is that a story?
Yes.
Wherein the best is behind us?
Right. So in real estate, Aisha, the thing is there is this big regulation which is around the corner, and obviously Indiabulls real estate, or for that matter any real estate company, is affected by it. I think this regulation is going to lead to a widespread consolidation. The regulations are going to make it very difficult for standalone, small-time real estate developers to remain in the business, particularly for metros and tier 1 cities. And that consolidation is probably the anticipatory trade that is, that has played out in real estate after the demonet shock. So it's not that real estate prices are on a tear. It's not that real estate volumes are taking off. God knows there are full-page ads every day in the newspaper saying buy so-and-so real estate, and activity in full swing and all of that. So there's desperate selling going on in real estate in the market for real estate. In the stock markets, I think the anticipatory trade has probably taken a few stocks well past what should be fair value, but that's how it happens.
So are you of the view that one should get out of real estate stocks?
So to our mind, many of them have already crossed fair value, and we've put quite a few of them under watch or under review. We're waiting for this quarter's not only numbers but clear-cut pronouncements from managements on what they intend to do with the business, where they intend to allocate capital, and what the progress on their in-process projects is. It's very difficult to take a view when the market takes or when prices jump up some 30-40% for most real estate stocks in a matter of months. I don't think there is any margin of safety, let me tell you, in many of these stocks. It doesn't mean that they are not long-term businesses worth owning, but if you want to make money for the next 2 or 3 months, real estate is not going to be the sector.
So what will be that one space?
So that's a tricky one, Aisha. I think there's every evidence that we are sitting on a scorching summer if you're looking for a short-term trade. Then the air conditioner and fan manufacturers are the obvious people to look at if that's how you want to play it every 2 or 3 months, or you look for something which is the flavor of the season. So we are very, very constructive on companies like Voltas and even Crompton Consumer, both of which I think from our channel checks seem to suggest that volumes are going to surprise even the most optimistic of people who are following them. They're not cheap. Crompton Consumer is probably trading at close to 30 times now. And I think the news of high volumes in this summer will probably create a sustainable base from where to build volumes in future. Remember that in Crompton, the other story is obviously the premiumization in their product mix. So fans is about, I think about 20-25% premiumized, so to say. And our channel check suggests that 40-45% premiumization over a couple of years is not infeasible. And remember that the premium end fans obviously sell for a much higher contribution.
Grasim and Aditya Birla Novo, they both are sitting at a 52-week high. L&T is also sitting at a 52-week high. Is there money to be made in either Grasim or Aditya Birla Novo? Because
so Grasim is now a complicated holdco, and even more complicated holdco than it used to be because of the restructuring which has happened. But you know what? I think shareholders of Grasim will now get something in the listed financial services entity.
And which is a big business.
Which is a very big business. So it's got, I think, Aditya Birla Financial Services. The NBFC, if memory serves me right, is more than 25,000 crore loan book. And across small business lending. And I think that is the reason why Grasim has perked up of late. The base fiber business is very interesting, and the holdco discount for Ultratech is now narrowed to, I think, from 46-47% to something like 35 odd. So there is certainly value, but there was always value in Grasim, you know.
I mean, if you buy Aditya Birla Novo right now, or Grasim for that matter right now, you get Aditya Birla Financial Services. They are big in mutual fund. They are big in insurance. Their lending book may not be retail dominated, but it's very decent. Yeah. NBFC is the flavor of
the NBFC and the insurance is what will drive the value there, and these are futuristic businesses to hold. There is so you know, you're sitting in an India which has already aggressively started its journey towards financial savings out of real estate and out of gold. The store of value is now financial savings. So the 4,000 crore odd monthly SIPs into mutual funds is but one indication. Strong accretion into bank deposits is another one. And of course the relatively underpenetrated state of life insurance is yet a third lever. Mutual funds obviously provides another lever, and so on and so forth. So you can keep on looking for multi-year growth opportunities in such businesses.
So where is it that you're investing in when it comes to insurance? It's a very small space.
So we don't have any of the insurance companies under coverage right now. They are difficult to analyze. Their business models are not simple models where you just analyze them on book value. There's something called embedded value, which is a statistical measure based on the portfolio of the insurance policies that have been sold, and there's a future value that you attach to the growth and so on. So it's a complicated story. We'll get there. But outside of insurance, if you'll allow me the liberty to change the subject, it's small housing finance, which despite the tough valuations looks very, very attractive to us. So when housing spreads beyond the metros and beyond the tier 1 towns, the 10 to 40 lakh rupee kind of loans are the loans that are still going at 12-13% and not the 9.5% that the LIC housing finances of the world are struggling to lend at and compete with the banks. So the 12-13% kind of yields offer companies like Repco, if I may repeat my words, a multi-year growth opportunity. So there are other people in the space as we have seen, but right now it's Repco that we are gung-ho on.
But the fact that they gave a lot of money, or their profile of their borrowers is non-salaried. It's difficult to judge the risk there. You know, everything looks great when the cycle is great, but when the cycle turns, if you are giving money to non-salaried class, your guarantee or your default ratios could be nasty.
And somewhere you can't hold them accountable as well.
Sure. So you have to look at these stories across cycles and see. So I could be lending to the non-salaried class, and I could have a completely different track record of lending to them over a couple of cycles versus you. So when you look at Repco's lending record over 2 or 3 lending cycles, you will see that the LGDs, as we call them, the loss given defaults, are negligible. The money always comes back. It might take long, but it comes back. So you classify something as an NPA, you provide for it, and what do you know, in 2 years' time you get back the money, or you are actually able to recover the value of that loan from the borrower. So because it's lent against a hard asset, and because house values up country haven't run away,
to let your house go. I mean, okay, fair point. I'm going to just change topic and talk about real long-term trends. You know, if you bought Maruti in 2004 when it went public, it has given a compounding return of 34%.
Right.
That's unbeatable. That's not going to happen again in next 10 years. But I'm sure next 10 years, a lot of companies will give a CAGR return which could be north of 25 to 30%. So give me a list of 3 names where you think that on a next 5, 7, 10 year basis, a CAGR return of 25 to 30% should be expected.
So we certainly feel that some of the greatest compounding opportunities will be available in the financial space.
Even now?
Even now. Because credit penetration to the underserved segments is still something that is 10, 15, 20 years, a cycle of 10, 15, 20 years is staring us in the face. So up-country lending, if I can call it. So housing finance is only one part of the asset financing there. But when you look at the business models of companies like Chola, when you look at the business model of Shriram Transport, for example, these are multi-year lending opportunities that have still not fructified to the level they could have. So Chola's got what, less than a 20,000 crore vehicle finance book. We don't see any reason why it shouldn't be 2 or 3 times this book. 3 times this book in 10 years is a feasible target for it to achieve. Shriram Transport is kissing 80,000 crores in the second-hand truck finance market, and a book size of twice this, let's say in the next 5 years, is eminently feasible.
But you're not so gung-ho about pure play banks, are you? You continue to think that asset quality will remain a stress, or at least in the year to come.
So the asset quality pains have affected different banks in different ways, of course. So the PSU banks have been the most battered on that front, and we've always felt that PSU banks hold an awful lot of value. But the thing is that something drastic has to happen on the bad loans recoverability front for them to get re-rated. And I've kept on saying that to my mind is the last hurdle that this government has yet not overcome in terms of its governance record. If that hurdle gets overcome, then a whole lot of PSU banks would get re-rated, and or they might enjoy the tailwinds of a good economic cycle and hope that some of the money comes back now. So that hope trade is a slightly weak thing to bet on right now. Within the PSU pack, of course, we are big admirers, particularly of Bank of Baroda, because of the new management and the way we think it is best placed possibly to gain from an uptick.
I somehow find the commentary very volatile.
Yes, it is.
So that just does not give me confidence. I mean, look at SBI, BOB and SBI. I mean, the difference between the commentary is so large that it absolutely amazes me. When there was trouble in State Bank of India, the chairman went on record and she said, look, there is trouble. There's a bumpy road ahead. When she was able to see visibility, she guaranteed and she assured investors that, look, we are witnessing a lot of visibility, and then she's delivered on that. With Bank of Baroda, you're changing colors with every passing quarter. So
that's a slightly unfair comment. Yes, I do agree that the results posted by the bank have been a little up and down and up and down.
So that's
but the
volatility.
So that volatility is actually a fair reflection of the kind of internal pain that this management has inherited, and our sense is that they are tackling this pain, and they are tackling it admirably. Sometimes you look at the metrics and take a call on whether things will work, and sometimes you look at the man in charge and then take a call on whether this is going to work or not. Here it's obviously about the fact that here is a legacy PSU bank which was corporate loan heavy, which was inherited by a professional manager who has been busy sweeping the dust and the muck around, and I think over a period of time they're going to get it.